Is Ajay Srivastava with us? I think Ajay is with us. Ajay Srivastava is Chief Executive Officer at Dimensions Corporate Finance Services. Ajay, great to have you with us here on the program. Thank you very much
Good morning.
for your time. Good to see you. Ajay, how are you feeling after all of the price damage we've seen? 7-8 days of not relentless selling, but one way down, right, for the market. How much of the froth is off and how much is left? Are we in a better place now to look for opportunities? Go on.
Good morning. I think nobody who has a long portfolio will be happy, Prashant. That's an honest fact that all of us are pretty long on the portfolio side, but so we're not happy people. But we are fair people to say that this was expected. The market is expensive. Still, a lot of stock continue to be very expensive. And I think you are seeing a normalization of P's in many stocks, good quality stocks, no doubt about it. So that normalization is happening. Movement of incremental money flows are slowing down as people move to fixed income, realizing that it's equity is a both ways game. You can go up and down. So all in all, I think it's a very healthy market and it's correcting in the right places. It's going in accordance with the government economic policy. You don't see any correction in the capital goods stock. If you look at it at all in the last 7 days, which is the way the market should move to. So I think all in all, when you say froth is out, I think perhaps I would say optimism is down.
Okay, optimism is down, but there's also this big narrative, right? Ajay, hi, welcome to the show.
Good morning,
retail
Sonia.
investors, good morning. Retail investors now perhaps prefer other avenues like fixed income. And I remember you telling us a while back that, perhaps fixed income is the place to be. Keep equities on the back burner for now. Is that going to be the case through the course of 2023? Or do you think things are going to turn at some point?
Sonia, life is such that things happen from somewhere you never expect to happen. Who knew Ukraine war would happen at all? It came out of the blue. Who knows something nice will happen out of the blue? And being optimistic, I would say, something nice should happen and surprise us. Maybe inflation goes down. Maybe Ukraine war stops suddenly. There is a ceasefire. Suddenly you'll find the market getting a different kind of traction. Maybe China numbers come out much better. So, people who are long in portfolio are always optimistic something new will come up. Having said that, I think the key here is now more and more to balance your portfolios to become peaceful, get into fixed income. That's one. Number two is, as what he said, Prashant said, frothy stocks, the high P stocks, whether it is a multiplex companies, whether it is the, you saw what happened to Adani Group, for instance, with a very high P rate. I think those stocks are suspect, except for the consumer space MNCs, which have a different traction, different investor base altogether. I think rest of the stock, which have high Ps, are still under the cosh at this point of time. And that is where you need to avoid getting in. The price may be down by 30%, but if the P is still north of 30 or 40, I think those stocks are the most suspect to be in. So I would not say carte blanche, we have a bad problem in the market. Capital good, as I said, Sonia, is wonderful. You can keep investing. You should be investing in capital good stocks. There's no doubt about it for the next couple of years. But rest of stocks, consumers, non-MNC consumer stocks, I think those are the first ones which will keep falling till they come to a P of 2025.
Hi, Ajay. Good morning. Ajay, the banking space delivered very, very good numbers, some of the best ever, but saw the hardest knock or maybe the worst possible correction post their numbers. So it seems the street is pricing in that the best of earnings are behind, which could be the case. But how do you approach some of these stocks post the correction? Would you look to buy some of them?
See, Nigel, the banking stocks are overbought in India for a long time. And that is one of the reasons why they've underdelivered is everybody holds them, right? Everybody's got stock of ICICI, HDFC, every mutual fund scheme has it, every multi-cap has it, main cap has it. So, so look at the amount of buying and the stock holding of the Indian institutions in the bank. FI, that's the number one holding. And the fact remains that at the end of the day, they're good quality stocks, but they cannot give you superlative returns. Simple fact, one of the most competitive industries in the country is banking at this point of time. RBI may shield it as much as it wants, but I think the moment the yield factor became a little bit positive, I think the problem with the bank started. And look at where they're growing, retail loans. Any economy in the world will tell you, and the story of banking has always been, when the economy slows down, retail loans get into a problem. We are just seeing the first, not even the first start of the slowdown of the economy in retail. Everybody's built his portfolio. Nationalized banks who have no expertise on retail loans are building up personal loans. So I think, I still believe that for the bank, it's a reverse thing. Indian economy, if it gives the performance, you will find economy stocks doing better than the bank in the best case scenario. In the worst case, of course, you know what happens with these stocks, banking stocks, nobody wants to buy them. But the problem is, Nigel, overbought, underperforming sector is the problem with the highest possible risk in the economy, if you ask me, is the banking sector today. So therefore, if you have mutual fund, you already have banking. Most people have HDFC, ICICI, whatever they got it. Incremental buying is a problem here, and that is where returns are going to come. If someone wants to buy bulk of banking stocks, and there's no buyer of that kind.
No, got that. And fair point. Ajay, you said CAPEX and infra, right? Now, but where exactly? Many are excited about railway CAPEX, but again, there are stocks which give you exposure. Maybe companies which make rolling stock or some particular component for the railways, or a player like L&T. I don't know. I mean, I don't know if you have any specific thoughts. But here also, right? I mean, L&T arguably is not very expensive relative to its own history, but there are names like Siemens, etc., which are still, I was looking at FY24 earnings expectations, they're still trading at almost 57, 58 times earnings. Pre-COVID, they were trading at, Siemens was trading at 37 times earnings. That's moved up to almost 60 times now. Is this CAPEX, the investment cycle, picking up in such a strong way to justify these kind of multiples here? Your thoughts?
See, I think, Prashant, you have to keep the basket of MNC capital goods stock in one bucket and maybe one odd Indian stock which has been re-rated. And the reason they are high priced is only for 2-3 reasons. One, they're not leveraged. In spite of being capital goods stock, they're not leveraged. There's surplus in the cash. Number two is there's no fresh supply of paper coming. Most of them are owned 75% by the parent, which has strong impetus to support India. Third is they've got large capex plans coming up, so you should see expansion of capacity over a period of time. So I think check the 3 boxes, and the government trying to spend the 10 lakh crore odd, whatever number is, in the economy. And where it's going to go? It's going to go to a couple of 4-5 companies at the end of the day, because they supply most of the high-end capex goods, whether it's steam locomotive engines, the electric locomotive engines and the transmissions and the signaling systems and so on and so forth. So I think, and for the power stations, etc. So I think you are safely ensconced in those couple of MNC capital goods stock, purely because the supply of paper is very limited, deleveraged players, and their capex plan tells us they should be going on a growth path of 20-25%. Whether it is a 50 is the right one, I do not know the answer, because the supply of paper is so limited that you can't buy bulk in the stocks, and therefore that the moment you start to buy 100,000 shares, you move the price by almost 8 to 10%. Now that's a dilemma for large investor, but I would still say that if there was a sector to buy into in the economy today, that would be the sector, even though it's a higher P, because the growth plans are good. Rest of the economy is struggling because the growth plans are sub, 10%, 8% kind of growth, maximum 15%. Here are companies with a growth plan of 25+%. So relatively speaking, if you want to put the money, where you want to put it should be these places, not where the guy is going to grow at 6% and a P of 25 even. Here at least is going to grow at 20-25% plus on a deleveraged balance sheet. I think it's a great positive. Suit yourself on where your comfort zones are, but you can't ignore them, can you?
Okay, no, you can't. Surely not. You also can't ignore the fall that Adani Group stocks are seeing at the moment. I mean, it's a complete slam dunk over there yet again this morning. Adani Enterprises, Total Gas, Green, Adani Transmission, Wilmar Power, there's just no recovery. In fact, Adani Enterprises is now down over 70% this year. So that continues to be the problem pocket for the market. Just wanted our viewers to take a look at those stocks. Steep falls continue in that entire group. But the one space that has recovered, Ajay, is some of these new age tech companies, right? I mean, I was just looking at the chart of Paytm, 20% up in February, 45% up from the 52-week lows of 430 thereabouts. You think this is a good time to be going all in to some of these names, Paytm, Zomato, Nykaa, or not quite yet?
All in are reserved for the poker table, Sonia. That's the place to go all in because the payoff is immediate, right? And it's in your hand. You know your cards, you know your people across the table. So I would recommend people to want to go all in, go to Vegas, put it on the poker table. You get a better chance of winning. Not against this market, believe me.
Are you saying gambling is a better option now than trading in the stock market?
Did you not say 70% down just now? If you're really going, in a roulette and a red and a black, I think you'll have more odds. On a blackjack, you have more odds than not losing 70%. I guess so. And I keep saying poker is all in, you want to go there. But I think on a serious note, I think, there is a need to be rational about what you expect from this market. And therefore, where you are you a starting investor? Are you an ending investor? Are you over leveraged? Can you sleep well? Tick box all these questions and you'll get some of the answers where to be in this market at this point of time, if you ask me. So as I said again and again, that peace of mind is more important to investment than any thesis you can understand. If you can sleep well, you've taken the correct risk. This market is risky. It will also reward the people who take risk. Mind you, I'm telling you again today, you can see Adani stock slam dunk, but you can say there are falling knives. You don't know where it's going to end up. But if you're a brave heart, you know, you got to go in and wade in and find some peace because there are physical assets there at the end of the day. Something will happen. Father Time will ensure the fact that all goes well with the most large groups, and you've seen what happens. And the time to buy is when they are lows. People who buy at highs never make money. So guys, have a brave heart. You want to do all in. You've got so many options in Indian market where all or nothing.
You guys are, I don't know what to make of it. As someone who doesn't play poker, I don't know what to say to this or add to this, but good conversation as always, Ajay. Great speaking with you.
Thank you very much.
Very much
you have a good
for
day.
being here on CNBC-TV18. Thank you. I want to highlight two names.